Okay. All right, everyone. Good afternoon. Of course, like I said before, this presentation is being recorded. My name is Brian Sodia. I'm the program manager for Maine and Baltimore. We are a program in the Baltimore Development Corporation, which is our city's economic development agency. The work of Maine and Baltimore is aimed at supporting and promoting makers and manufacturers here in Baltimore City and helping to grow the buy local movement in the Baltimore region. We offer business development services and resources to small batch makers, manufacturers, and retailers. We do this through programs like this Tools and Trade Workshop. Today we have the amazing privilege of being here with John Renner from Timshel Development for commercial real estate 101 buying versus leasing. John has 20 years of experience as a real estate developer, development consultant, and financial advisor for complex urban revitalization projects. He has managed a wide variety of project types, including adaptive reuse, master plan communities, high-rise urban infill, and the gut renovation of small multifamily buildings for affordable housing. He has experience with most types of tax credit and special finance programs, including green building tax credits, energy tax credits, new markets tax credits, low income housing tax credits, state and federal historic tax credits, PACE financing, and tax increment financing. Timshel currently is leading the redevelopment of the parlor at 108 West North Avenue and the North Avenue Market. So if you're a local to Baltimore, please be on the lookout for those amazing projects. We ask that you please remain muted through this presentation. We would love to see your beautiful faces. If you're comfortable, this is a safe learning space. So there's no such thing as a bad question. If you have a question, please quietly add it to the chat and it will be answered during scheduled Q&A segments. Don't feel pressured to keep up with note taking. Again, this workshop is being recorded and will be posted on our website at a later date. A big thank you to you all for showing up. A big thank you to our parent agency, the Baltimore Development Corporation. And with that, John, I'm going to make you a host and let you take things from here.
Okay, thanks for the introduction. Let me try to pull up my presentation. Okay, can you see my screen?
Yep, sure can.
Okay, good. Um, yeah, as you all heard from my background, I'm mostly a developer. I'm definitely not a professional teacher. So feel free to interrupt me or put questions in the chat if I'm going too fast or I'm skipping over things that you want to hear more about, or just if you have any questions. And I'm going to leave plenty of time at the end, hopefully, for discussion and questions. What I'm gonna, let me make sure I can advance my slides. Okay. I'm gonna go through kind of the various stages of finding commercial real estate and then making a deal to occupy that space, whether you're buying or leasing. Uh, I'm going to go through the pros and cons of buying versus leasing specifically, and then go over some key terms, some of which are only applicable to leasing, some of which are only applicable to buying, but some have overlap. Uh, and kind of the first place you start, I think, with commercial real estate is getting to know yourself and getting to know your needs so that you're looking for the right thing. I think it's not totally dissimilar from dating or something like that. The better you know yourself and the better you know what you're looking for, the more efficient you can be in finding the right thing. Um, so with your types of businesses, which you all know better than me, I've found that there are a lot of kind of specialty needs that are different from an office tenant or a retailer, which have more kind of consistent needs between them. Some of you might need tall ceiling heights or exhaust fans or a loading dock, all kinds of things that impact the type of space you'll want to lease. So I recommend just making a list of all of those things, and some of them can be things you absolutely have to have, and other ones can be just things that are nice to have. It could be that you need 4 parking spaces, and that's non-negotiable because you want to be able to park safely right at your location. And then you may want to be near a coffee shop, but that's something that you could potentially do without. So I recommend making a list of the things you need and you want and prioritizing them or just putting them in a few buckets to help you kind of sort through spaces as you see them. There's also a lot you can do in advance just to get ready financially. Both landlords and definitely a lender, if you're getting any loans, will take a deep dive into your finances and your business plan. Because if you're an emerging company, you may not have a multi-year track record of sales and profits. So the lender or the landlord is going to be underwriting you on the basis of how good we think your idea is, how well thought out it is, and your planning. So I'm sure for other reasons you've learned about business plans, and it's a good idea to have one for the real estate stuff as well as just everything else. Um, and then you definitely, commercial real estate is like anything else. It's like a specialized knowledge base. I've been doing it for a long time and I still learn things every day. And when I have to do something like when I go to buy a building or when I negotiate a lease with a tenant, I always have a lawyer at my side and sometimes other types of professionals. And if you're, before signing a lease or a purchase agreement, you definitely want advice, like sound legal advice and advice from other people who do this for a living and can help you because chances are your specialty is what you make and not real estate stuff. And finally, I think it's important to come prepared with what you offer to a landlord. Uh, when I meet with some types of makers, and I'm just telling you my kind of how I guess I'm like judgmental or whatever. Often I think, okay, how are these people really going to pay rent? And or it's going to be really expensive to build out their space because they need a commercial kitchen or they need a lot of power capacity or something that's going to be really expensive to install. So I come with a certain amount of not cynicism, but sort of like a wait and see approach to make sure this company is for real and can definitely be um, a good tenant. So you're working against that. I mean, I think most developers or landlords probably think like I do, or worse. And so you need to know your value, like what you're offering to the situation. And I think right now, commercial tenants have a lot of power because we're all still experiencing the fallout from the COVID-19 pandemic. There's a lot of commercial real estate that's unoccupied, less than a year and a half ago, but still. So you have some power. But there could be other things. I mean, you could, have other companies that might want to co-locate with you, and therefore you can help the landlord fill more space. Or it could just be that you can occupy space that the landlord can't lease to anyone else because it doesn't work as retail, it doesn't work as office, but you could make something there. So just think that through so you have your pitch ready before you get in front of a decision maker. In terms of finding space, I'm definitely not an expert on this one. You know, the landlord always pays the broker. So in one sense, there's no reason for you not to use a broker because that someone is working for you who you ultimately don't have to pay for. On the other hand, brokers get paid based on how much rent the tenant ends up paying. So if you're looking to lease like 500 square feet or even 2,000 square feet, most brokers aren't going to pay you a lot of attention. They're going to focus more on someone leasing 100,000 square feet. But there are good brokers out there who want to help local businesses, and you may just know, you may have someone in your network who's a broker. There are a lot of them out there who just want to help you because they know you, and that's the kind of person you want to work with. Of course, there are a lot of online resources for commercial real estate, not quite as many as for buying a house, but there's still a lot out there that are easy to find. I think the more interesting and maybe productive way to find good space is through networks. There are city and state agencies that are out there to help small businesses and could be a conduit to space. And then I think a really great place to go is to kind of pick a neighborhood and then figure out who the people in the know there are. There are community associations. There's sometimes I work a lot in Station North, so I deal a lot with the Central Baltimore Partnership, which oversees like 9 neighborhoods in Central Baltimore. A lot of neighborhoods have something like that, or we have at least 4 great art districts you could choose to locate in one of those areas and then work with the arts district staff who probably have their ear to the ground on good space available for artists and makers. And then, of course, there are organizations like Made in Baltimore. Made in Baltimore has relationships with developers, so that's a good way to find developers and property owners like me. And there's maybe a dozen others who are interested in working with makers and have the right type of space. For example, one of the projects I'm working on as a consultant, the whole purpose of the development is to create scale up space for small scale manufacturers like those that are growing out of open works, and the building is within a stone's throw of open works. So I'm not the developer there, I'm just advising them, but that's developer is an example of someone who, is specifically looking for you. And then just through the process, tour as many spaces as possible. I think that goes without saying, but it's like anything else, like at least see 3 or 4 things before making up your mind. Okay, yeah, Brian asked me to do a kind of a deeper dive into the pros and cons of leasing versus buying, and definitely stop me here if you have any questions. And I do have an opinion on this, but I'll try to give you my unbiased view and then sort of tell you what I really think at the end. But there are definitely strong pros and cons to each. Scenario. And starting with leasing, I think the biggest one for emerging businesses is just that leases are more flexible in the sense that you can sign a 1-year lease or a 3-year lease. And then if your business needs change at the end of the lease term, you can lease something different or not lease space at all, or lease something 5 times as big because you got a contract that you now need to fulfill. Uh, it's definitely easier and faster to lease than to buy because buying can be a 6-month process, whereas leasing, if you find a space you like and the landlord's interested in working with you, that can come to fruition in a month or 2. There's obviously no down payment required with a lease, and it's pretty predictable what you'll be paying in the future. There could be some variations in expenses that the landlord passes on to you, but the lease rate itself will be known in advance. It may increase over time, but it'll be known in advance. Whereas if you own a building, you know what your mortgage is going to be, but you don't know if you're going to have to replace the roof in 4 years, just as one example. And there are lots of examples like that. Another good thing about leasing is the landlord might help pay to customize the space to your needs. That's not always the case, and it definitely depends on how much rent you're willing to pay. But I'm accustomed to helping to finance the build out of tenant spaces. It's fairly typical, And that way, the landlord is essentially financing it by paying for it up front and collecting rent from you over time. And you don't need to deal with a bank or something like that that has high fees and high interest rates and a lot of headaches. Um, yeah, and then, so if you're part of a larger building with multiple tenants, then sometimes those buildings have things shared by all the tenants, and that way you don't need to pay to create it for yourself. That's not always the case, but a lot of buildings these days especially have shared loading docks, shared conference rooms, shared kitchens, and so forth. So you're helping to pay for it through your rent, but you're sharing it with other people, so the cost to you is significantly less. Um, in terms of the cons of leasing, and of course, the big one is that you pay rent to a landlord and you're not building any wealth. And I think that's what most people think about when they think about buying. And I get it. I was kind of a lifetime renter until 10 years ago. And when I look back on all those years, I kind of wish that I'd been making down payments and working towards owning something. Um, some other cons, you're not in control. The landlord is really, it's their space. I mean, they'll ultimately have a say over what you do in it, and that's a pain in the butt. I mean, it's great to have your own space and totally control it, and that's not totally the case if you're a tenant. Um, yeah, it's not, a lease isn't permanent. I think that's maybe a reason to lease, but it's also a reason not to lease. At the end of, if you do a 1-year lease and you think, oh, well, if I still want the space, I can just renew the lease with the landlord. They were super nice. It could be that at the end of the year, the landlords develop new plans and you're out. And of course, there are bad landlords out there. I think at least 2 of the leases I've signed in the last 6 months, and I don't sign a lot of leases. They're few and far between. But 2 of them have been with tenants who just had a horrible situation with their current landlord. And it always shocks me to hear the kinds of things my peers in the real estate industry are doing. But not, of course, not all landlords are bad. I don't think most of them are bad. Most of them are profit oriented, but not bad people. But of course, there are unscrupulous people out there that you have to watch out for. And then with leasing, I think it's harder for you to raise money, particularly grants. If you're the people, it's not impossible, but it's easier, I think, to secure grants if you're leasing. Excuse me, if you're buying. And then the pros and cons of buyings, we'll go back over some of the same concepts. The pros, of course, is you're building equity in the property with your mortgage payments. I think if you wait long enough, most real estate goes up in value over time. It's not a guarantee, but it's extremely likely. You have total control if you own the building. Of course, there's city regulations and that kind of thing, but you don't have a landlord looking over your shoulder. Um, there are tax advantages to both leasing and buying, but there are more tax advantages to buying, and it's nice as a building owner, like every dollar you spend on that building is deducted from your income when you go to do your property taxes, which is why, maybe not the only reason, but one of the reasons you hear people like Donald Trump, say, or we find out that they haven't really paid taxes, is because our system is set up to really advantage property owners. Our tax system is set up to advantage property owners. Yeah, and another thing that could be possible is to buy a building that's larger than you need right now. So at least for a few years, you could lease space to other companies or organizations, and get rental income. And, I guess in an ideal scenario, you're getting enough rental income to pay your mortgage. And like I said, there are some grants and special financing programs out there for purchasing real estate, particularly in certain neighborhoods. Um, the cons to buying, I think the big one is like you're stuck with, I mean, not permanently stuck, but you're probably stuck for a while with whatever you buy. Uh, it's just it costs so much to buy and sell real estate that you're not going to want to go through that process most likely and turn around and sell it a year later. You probably need to look more to like a 10-year or more time horizon to justify it unless something crazy happens with the market. And a lot of times, I meet with a company that makes something. The story is sort of, okay, I started out leasing 1,500 square feet for production, and my business was booming, so I moved to a 3,000 square foot space and we're busting at the seams. So I want to buy a 5,000 square foot building. And I always think to myself, like, what if your rate of growth continues? I mean, I don't know their business, they know their business, and maybe they know the upward limit. But I always wonder, if you've doubled in size in the last 2 years, how do you know that you won't double in size each year for the next 4 years, and you'll need a 20,000 square foot building or 50,000 square foot? So I think buying really only makes sense if you have a very clear picture of your trajectory as a business and a very clear idea of what you need. Um, some other cons are, obviously you're totally responsible for all costs, whether it be replacing the HVAC system or taxes, insurance. Sometimes with a lease, you help pay for expenses, but it's all on you if you're the building owner. Um, and you'll need, most likely, unless you're sitting on a lot of cash, you'll need financing to buy the property, which is tough right now for everyone. Interest rates are high, and commercial lenders are more nervous than usual. They're always nervous, but they're more nervous than usual. Um, and you probably only, just like I can only borrow so much money as a small business, and it definitely limits what I can do. In your situation, you'd be using your limited ability to finance something with real estate, not other things you might need to finance, like equipment or inventory or staffing. So that's just something to consider. Um, yeah, I talked about capital improvements, which, the cost of things nowadays, roofs can be a couple $100,000 on commercial buildings. Same with HVAC systems. Like, there's a big difference between commercial and residential. Commercial is sort of like getting married, like where everything is 100 times, not 100 times, but like twice as expensive than it would be in any other context. Commercial real estate's like that to residential. Like, everything just costs twice as much, even if it's the same thing, because it has to meet different standards. Um, I kind of already mentioned this, but as you may know, if you've bought a house, there are closing costs you pay as the buyer, and just that owning real estate's a responsibility, and it'll take up a lot of your time. So I mean, maybe I'm biased as someone in the business of leasing real estate, commercial real estate, but I think, like, probably in 4 out of 5 cases or 9 out of 10 cases, it makes more sense to lease than to buy right now. If you're kind of in the startup stage or in an emerging stage, that might change. The cases where it could make sense to buy are, again, if you really know what you need over a long time horizon, or if there's someone out there who wants to basically pay for it all for you, and that happens sometimes. I get a lot of grants for the work I do from neighborhood groups, and it's possible for you too, but it's It's not a guarantee, but it's if you're thinking about buying, you should at least explore the potential to get grants to help underwrite your acquisition and renovation costs. I'll pause just for a second to see if anyone wants to interject something at this point. Okay, all right, feel free. Once you've found a location you like after touring a bunch of different places and doing your research, I recommend doing even more research. Uh, like I was talking about before, there's some not great landlords out there or property owners that you don't want to deal with. When you're in the real estate industry, you might just know not to deal with that person. You might not know since you're in a different industry. So it's good just to do research, talk to people, find out the reputation of the people you'll be dealing with, um, including other tenants in the building, if you have access to them, or just like what has their experience been is would be interesting to know before you sign a lease. Uh, Definitely in kind of the maker sphere, you have to be aware of zoning code and building code because there's just a lot of regulations related to what you do, where you can be in a building, what kind of building, what its construction type has to be, and then where it's located. Some properties are zoned to allow manufacturing, some are not, and the type of manufacturing you do uh, could be allowable in one zoning code or not another, and not another very similar one. And it depends what you're making too. So there are zoning experts out there, land use attorneys that you can talk to, or just that someone helpful at the city in the city planning department. I would definitely check with them before buying a building. And then it's important to, once you find a space you like, confirm that it meets your needs. A lot of landlords will pay an architect to do a concept plan of your space. Kind of what I'm showing on this slide was um, one we did for a yarn dyeing company. Just before we entered into a lease with them or explored it any further, we wanted to make sure their vision fit in the space, and we wanted to know what it would cost to build it out. So we asked our architect to do a plan. We were able to get a general construction estimate based on that plan, and we could tell whether or not the deal made sense. Um, and then, yeah, once you've found your spot and you have a sense of what it would cost, that's the time to refine your financial projections. Like, what is it really going to cost month after month to occupy the space? Not just rent or your mortgage, but everything else too, from Wi-Fi to security, electricity, all that stuff. Like, what's your monthly not going to be? And then what money do you need up front to customize the space to meet your needs? So like I said before, some landlords will help pay for that, but almost certainly you'll be coming out of pocket as well. And then if you're buying, there's like a whole nother level of homework you should do. And I think the key thing here that I think a lot of people don't know about who don't buy commercial property, because this is definitely different in some ways than residential, is most commercial purchase agreements have something called a study period. It can be called an inspection period or due diligence period. But basically you sign a contract with the seller, and then you have some period of time where you have access to the property, but you don't own it yet. And you have access not to occupy it, but to kind of kick the tires and perform tests and just look around, show it to your friends, show it to your funders, and make sure it works for you. And those due diligence periods or study periods can be 30 days, they can be 180 days. It all depends on what you're able to negotiate. And you usually have to put up a deposit when you sign the contract, but that deposit is fully refundable to you until the end of the study period. So I would say that's, if you're going to buy, that's the key thing to negotiate in the contract, to make sure you have time to really understand the building before you close on the acquisition. There's a lot of different due diligence you could do. I mentioned zoning again here. It's important to get someone to look, a title company to look at the title. And then just like you do a home inspection, you'd want someone to do a contractor to do a thorough inspection of the property to make sure the roof isn't about to fail, or the floors have structural issues, or any number of things. There isn't really as robust a market for people who do commercial property inspections as there is with residential, but a lot of general contractors can do it. Uh, and that's who I usually use, rather than going to like someone who just does inspections. I want someone who's working in construction every day. And then finally on this, with you know, um, a lot of older buildings especially have environmental issues, and if you're buying the building, that then becomes your problem. Um, and that could be a hazard. It could be a hazard to you or your employees if they're breathing asbestos or whatever. And in some cases, you could have legal liability. Just as an example, it's illegal to have an underground storage tank on your property. Lots of people still do, and it's not enforced very often, but it's illegal, and that could eventually come back to bite you. And it's something your lender would definitely be worried about. And I'll kind of, I don't have too much more. I'm going to wrap up just by talking about some key terms. And I'll send this presentation to Brian, so you have this. But with leasing, I think the most important idea is what type of rent you pay. And there are three most common types: gross, triple net, or modified gross. Gross gross is much like rent, is the most like renting an apartment. You pay one thing to the landlord and it covers everything. Triple net is, there are two components of the payment. You still pay rent. It might be a lower rent, but you still pay rent. And then you reimburse the landlord for your share of all of their expenses. So that means taxes, the insurance the landlord carries, and common area maintenance, utilities, that kind of thing. The triple, as a landlord, I always want a triple net lease structure, just because if the cost of utilities fluctuate or the cost of insurance fluctuates, which it has dramatically in the last 2 years, that's the tenant's problem, basically, because they're reimbursing me for that, no matter what it costs. So I want triple net as a landlord. Gross is usually better for the tenant, because that risk of expense fluctuation is on the landlord, not on you as a tenant. There is a kind of a compromise lease structure that I actually is very common with manufacturing. So common that people sometimes call it industrial gross instead of modified gross, but more, I usually hear modified gross these days. And in that structure, you pay rent, and you pay a very limited amount of expense reimbursements to the landlord. And usually it can be anything, but usually how it works is you reimburse the landlord for any utilities they're paying on your behalf, like water and sewer, or anything that's not individually metered. Sometimes there's some other components to that, but So it's sort of a balance between the two, and I think it's generally a good place to end up if you can get it. Uh, you know, you probably know this already, but it is normal for your rent to escalate each year. 2 or 3% is very common. It could be anything, but I usually try to get 3% and settle for 2.5% on that. Some tenants can negotiate 2%. Um, And then I don't know how often this will be the case, but as landlords, we want to get rent on the whole building, not just the space you're occupying. So will basically inflate the size of your space so that it includes a portion of all the common areas like hallways or a lobby or the bathrooms. So if you're leasing 1,000 square feet, we'll charge you rent on 1,200 square feet to account for some of those common areas. It's legal, it's normal. It's probably more common than not common with office leases. It's less common with I would say small manufacturing spaces, but it still could be a concept that you encounter negotiating with the landlord. Um, Yeah, just a few other things, easy things. The premises is just the real estate word for the space you'll occupy, as distinct from the rest of the building. Term is how long the lease is. And then term and rent commencement date are terms you'll find in a lease, and that's important just because you don't necessarily need to start paying rent the same day the lease starts. I would say uh, tenants are not expected to pay rent when they're building out the space or customizing the space. Anything's possible, but it's not. Often you can get kind of a grace period, I would call it, before you start paying rent to build out the space. And then depending on the landlord and your negotiating position, you could negotiate more free rent at the beginning of the term, particularly if it's a longer term lease, like 10 years, or 7 or 10 years. And then another reason why leases can be good is that you can sometimes negotiate the ability to expand into an adjacent space or into a larger space in the building when it becomes available. Those are often called a right of first refusal or right of first offer. I would just be aware to discuss that with the landlord, whether or not it's a possibility, and it could be a win-win for both of you. And I think it's important to think about like having an out if things don't go as you expect with your business. Some tenants are able to negotiate a clause that allows them to terminate the lease before the end of the term. If sometimes it's like the tenant has a one-time right to terminate after 6 months or after 2 years, or it could be for another reason, or it could just be a blanket right to terminate with sufficient notice. So not every landlord will give you that, but it would be great if they do. And yeah, and you should have the right to assign or sublease the space. That's another way out if things don't go well. The landlord may want to approve the tenant you're assigning the lease to, which is reasonable, but you should definitely have the right to do that. And then some key concepts with buying real estate. A lot of these I went over previously. Just in commercial real estate, we call the contract a purchase and sale agreement. I'm not sure if they call it the same thing in residential real estate. I talked about the study period. That's really important to have some time before your deposit becomes non-refundable. And then at the end of the study period, you should have even more time before it's your deadline to close. And then this could be a whole separate class, but I just listed some things to be aware of when you go to get financing. It's definitely different than buying residential real estate where a lender might give you 90% of the purchase price or even more in some circumstances. Best case scenario probably is you're getting 75% of the purchase price as a loan. So it's just more cash you need to have in your pocket if you're looking to buy. And then the bank is going to require all kinds of things which you'll pay for, like an appraisal, which is just a third party's estimate of what the property's worth. They'll want a survey, title commitment, which is just doesn't really cost money, but that's a commitment from a title company to provide title insurance. And then obviously they'll want a lot of things from you. And I go, having been through it myself, a few times recently, it's a lot, that commercial lenders require. And they often want you to guarantee it personally. So they'll take the real estate itself as collateral, but they'll want you to also guarantee repayment, which means they can go after you personally if things go poorly. And theoretically, more than theoretically, but there's an unlikely event they could take your house if you own your own house, and they could take your 401k, anything. I always worked for other companies until about 3 years ago, and I bought a building and started renovating it. And yeah, I had to go through with my wife, who doesn't do real, she's a teacher. I had to go through everything it means that I was required to provide a personal guarantee, and like what assets that she brought to the marriage are sort of safe, and what assets that we have together are not safe. So it's a big decision. And then finally, in some cases, and it's relatively common, that a seller will provide you financing. So let's say a property costs $1 million, they might take $300,000 from you in cash, and the remaining 700,000 can be paid over some period of time. It's potentially a good situation because the seller is not going to underwrite you as carefully as a bank and have as many requirements. By the same token, um, banks are regulated and they have they have their reputation to consider. A property owner may not care about you, and if they need to foreclose, they're just going to do it. So you could get wiped, in that scenario, if you put in 300,000 and you stop making payments, you could just get totally wiped out. So it's not, there are pros and cons to using the seller for financing versus a bank. Uh, Yeah, and then making a deal for a lease or to buy a property. I'm definitely not the best negotiator in the world. The best advice I can give is that everything under the sun is negotiable, no matter what they tell you. And then uh, don't fall in love with the building. This is advice to myself as much as to you, but when you fall in love, and I have a bad tendency to fall in love with old falling apart buildings. When you fall in love, it's harder to walk away. And to be a good negotiator, you always need to maintain the ability to walk away. And then just another term to be aware of that you may have heard of in other contexts is a letter of intent, or most people say LOI. That's a non-legally binding document that outlines all the key business terms, either for a lease or to buy a building. So those are usually prepared by the buyer if you're buying a building, or by the landlord if you're leasing. But it's good to start with an LOI before a full contract is drafted, just so everyone's on the same page about what the terms are. And then the last thing I wanted to talk about is customizing a space. I was thinking more about the leasing scenario in this, but it applies to either situation. You're going to inherit a space from a landlord, maybe somebody else just moved out, and chances are it's not ready just like it is for what you intend to do in the space. So it needs to be built out. And we unfortunately have a lot of different phrases for this. Sometimes people say fit out, sometimes build out, sometimes tenant improvements, but they all mean the same thing, customizing a space for a specific business's need. Um, what you get from the landlord or what you start with before it's customized is often called the base building or condition of premises in a lease or a LOI. That also has different phrases. I think that's probably less important. I think that the most important thing is like understanding the condition of the space you're inheriting from the landlord, really understanding the modifications you need for your business, um, and what that's going to cost, and then finally who pays for it. Like I said before, sometimes the landlord will pay for a portion or all of it. Sometimes they won't pay for any of it. They'll just say, you get what you get, and this is the rent, take it or leave it. And that doesn't mean it's a bad deal because that landlord is probably asking for less rent than the landlord who's willing to finance your improvements. It's just it kind of depends on your situation, what's better. Um, if a landlord provides capital towards building out the space for you, that's usually called a tenant improvement allowance in a lease or an LOI. So you can ask prospective landlords if they'll provide a tenant improvement allowance, and if so, how much. Um, and I know I said grants are more common if you're buying a building, but you can get grants for building out your space. I was working on something this morning, and I copied uh, the Central Baltimore partnership on an email I sent to a tenant prospect, and the Central Baltimore prospect chimed in immediately and said, "We'd love to have you in this neighborhood. Let us know how we can help pay for these build out costs." So depending on where you are, it's certainly possible to get grants for build out costs. That's all I have. My contact information is up on the screen. I'm happy to answer any questions now or after this presentation, and I'll send the presentation to Brian in case anyone wants it. So yeah, let me know if you have any questions or comments.
All right, okay. It looks like we have a question. What types of grants are available for individual businesses or building owners, and where would we look for these? My experience is only with grants for nonprofits.
Yeah, I mean, I think the main trick with that is to work with a nonprofit that wants to help you. Like I'm a business, so I can't apply for most types of grants. So I find a nonprofit partner essentially who wants me to do the project in their neighborhood and will incentivize me by giving me grants that they've secured from, you know, the state or a foundation. So that's the most typical scenario. So that could be true, for example, of course, in central Baltimore, let's say you found a place in the Black Arts District on Pennsylvania Avenue. That organization might want you in the district, and they might be able to apply to a state agency to get you money. Um, and then for businesses, there are kind of subsidized financing programs available where it's not a grant, but you're getting a loan at a very low interest rate and flexible terms. And I don't know if the BDC still does those. I know the Maryland Department of Housing and Community Development does through its Neighborhood Business Works program. And then there are nonprofit lenders like Baltimore Community Lending that want to help small businesses in Baltimore City. And yeah, I don't know how great their terms are, but they're better than working with a bank.
Yeah, you can actually, for anyone here who hasn't already, you can actually also sign up for our next workshop on June 27th, where we'll have the director of the Business and Neighborhood Development Team at the Baltimore Development Corporation uh, explain in further detail about how the agency helps provide technical assistance, grants, and funding for individual businesses and people looking to develop buildings. So if you haven't done that already, I would do so. And like John mentioned with Baltimore Community Lending, we have also done a workshop with them in the past that is on our website and our YouTube called Where to Find Money for Your Business in Baltimore. After you leave this workshop, you're more than welcome to head to our website and check out that workshop too to see what some of the potential offerings from Baltimore Community Lending are for your business. All right, does anyone have any other questions? And again, if not, John's information is on the screen. Um, so I'll give y'all about another minute to get any questions in that you might have. All right. All right, that looks like that is it for us. Um, Thank you so much, John, for this
Yeah,
incredible
thanks for having me.
presentation. Yeah, and thank you to all of you who showed up. We definitely appreciate you, and thank you to everyone that is viewing this at a later date, either on our website or on our YouTube. Again, this workshop will be available in the coming weeks via our website, madeinbaltimore.org, and our YouTube at the Made in Baltimore program. Um, Thank you again to you, John. Thank you to our parent agency, the Baltimore Development Corporation. And with that, we will see everyone again on June 27th for commercial real estate technical assistance with the Baltimore Development Corporation. So if you haven't signed up yet, make sure you get your free ticket. And
Thanks,
with that,
bye.
yeah.